Welcome to Module 3, Implied Volatility and IV Crush. Implied volatility, or IV, is one of the most important yet misunderstood concepts in options trading. Mastering IV can significantly improve your ability to assess risk, select contracts wisely, and avoid common pitfalls like IV Crush, which can erode your profits faster than any market movement. Let's break it down. Implied volatility reflects the market's expectation of future price movement. Unlike historical volatility, which looks at past stock movements, IV is forward-looking. It represents what traders expect the stock to do. Key features of IV. It tells you the expected annualized price movement of the stock. IV changes based on market conditions, news, and investor sentiment. High IV makes both more expensive, while low IV makes them cheaper. Now, let's look at how IV impacts options pricing. Implied volatility is a major factor in an options price, specifically its extrinsic value. When IV is high, options become expensive. This happens before earnings reports, product launches, or major news. The market anticipates big swings, and traders are willing to pay more for potential upside. When IV is low, options are cheaper. This happens when the market is stable, or after a big event has passed. The market expects minimal movement, so options lose their added premium. Understanding this concept is critical to avoid overpaying. But there's something even more dangerous: IV crush. IV crush is the sharp decline in implied volatility after a major event. When uncertainty disappears, IV drops, and with it, an options price, even if the stock moves in your favor. Before an event, high IV inflates option premiums. Traders speculate on big moves, pushing prices up. After the event, the market realizes the expected movement wasn't that significant. IV collapses, causing option prices to drop sharply. Example: let's say you buy a Tesla call option for $10 before earnings. Tesla stock rises by $20 after the report, but your option price drops to $6 due to IV crush. Instead of profiting, you actually lose money because the IV collapse outweighed the stock's movement. How to avoid IV crush. To protect yourself, here's what you need to do. Step 1. Recognize high IV periods. Look for key events like earnings reports, major news, and product launches. Use IV charts on platforms like Thinkorswim or Options Profit Calculator. Compare current IV to historical IV. If it's much higher than normal, expect IV crush. Step 2. Use strategies that benefit from high IV. Sell options instead of buying. Take advantage of inflated premiums. Use strategies like iron condors. Sell both calls and puts to capitalize on IV drops. Covered calls. Sell calls on stocks you already own when IV is high. These advanced concepts are covered in our Options Selling for Income Master Series. Step 3. Avoid buying expensive options. High IV equals overpriced options. Instead of buying calls or puts, use spreads to offset inflated costs. Step 4. Trade after the event. Instead of buying options before an event, wait until IV settles. Step 5. Use IV rank and IV percentile. IV rank shows where current IV stands compared to the past year. IV percentile tells you how often IV has been lower over the last year. Example: if a stock's IV rank is 90, it means IV is higher than 90% of past readings, a strong warning sign for IV crush. Step 6. Hedge against IV crush. Use vertical spreads. Instead of buying a call, create a bull call spread by selling a higher strike call. Try diagonal spreads. Buy a longer-term option and sell a short-term one to profit from IV decay. These strategies reduce risk while still allowing for profit potential. Key takeaways. Understand IV's role in pricing. High IV inflates premiums, low IV deflates them. Spot high IV periods. Compare current IV to historical IV to detect inflated pricing. Adapt your strategy. Avoid buying overpriced options and consider selling strategies instead. Prepare for IV crush. Be cautious around earnings and hedge risk using spreads. By mastering implied volatility and recognizing IV crush, you'll avoid common trading mistakes and add a crucial layer of risk management to your options trading toolkit. In Module 4, we'll explore contract selection strategies to help you choose the best options for your goals. See you in the next module.